Hi, I'm Anita Horsa, the Europe editor at The Banker, and we're here at the EBRD's annual meeting in Samarkand, Uzbekistan. Joining me is Beata Javorcik, who is the chief economist at the EBRD. Welcome, Beata.
Hello, Anita.
Beata, you published a sort of regional economic outlook earlier this week at the annual meeting, and it sort of had the title Getting By, which doesn't sound exactly positive. Can you give us some insights into why you chose that title?
The title of our report reflects a very challenging situation of households in the regions where we operate. Data from a very recent survey show that the majority of families are barely making the ends meet, and that majority of families would not be able to cover their basic expenses for more than 1 month if they were to lose their main source of income. In Western Europe, we talk a lot about the cost of living crisis, but this data from emerging Europe, where the situation is much more difficult, where people are hit much harder by inflation, actually puts our Western cost of living crisis into perspective.
So the cost of living crisis, you're saying, is having more of an impact in sort of Eastern Europe and Central Asian region?
That's correct. In general, inflation hits harder households that are poorer, and that's because they spend a larger share of their budget on essential goods, on basic necessities. In emerging countries, households have less savings to draw on. They have less of a buffer, and the two crises that happened in close sequence have further depleted those already meager buffers.
And in the report, you paint a very sort of mixed growth picture across the EBRD regions. In Central Europe and the Baltic states, you say they're set to experience the lowest rate of economic growth. What are some of the factors stifling growth in that region?
It is going to be a very difficult year for Central Europe and the Baltics, and three factors in particular are at play there. First, energy prices, particularly prices of natural gas, remain elevated, and in Europe they are 6 times as high as prices in the US, and that's going to reduce the competitiveness of the manufacturing sector on which the region relies heavily. Second, high inflation is eroding the purchasing power of consumers, so we are going to see weak consumption. And third, slowdown in Germany is going to result in a lower demand for exports from the region.
And then by contrast, we have the Central Asian region, which I think you predict is going to grow by 5.2% this year and possibly more next year. What's behind this sort of high rates of growth in Central Asia?
Indeed, Central Asia has proven to be quite resilient to the fallout from the war. Some of the countries are exporting commodities, so they are benefiting from such exports. But also the region has seen a large influx of labor and capital from Russia. Many companies, particularly in the IT sector, have relocated here. Second, the region also sent a lot of migrant workers to Russia. There were 3.5 million new migrant workers registered in Russia last year, majority of whom came from Central Asia. And finally, the region is serving as an intermediary when it comes to trade between Western Europe and Russia.
And as the Central Asian region is serving as an intermediary, are there concerns about perhaps that some countries may be aiding sort of goods getting through to Russia?
There is a concern that some of the Western goods that are subject to sanctions are finding their way into the Russian market. We have seen a very dramatic drop in direct exports from Europe to Russia. These exports went down by more than a half. At the same time, Europe is exporting more to Central Asia and Caucasus countries, And in turn, these countries are selling more to Russia. And these increases in intermediated trade are particularly pronounced for goods that are partially or fully subject to sanctions. However, it's worth pointing out that the intermediated trade in sanctioned goods accounts for a very small fraction of the direct flows that stop taking place, on average 5%. However, for some particular products, the replacement ratio may be larger.
So something to watch out for, I guess, in the coming months. What happens if they tighten sanctions more? Do you think that would have a negative effect on the Central Asian region?
Although the replacement ratio is small, for some of the smaller countries in Central Asia and the Caucasus, this intermediated trade is large when compared to the size of GDP. So it is a significant source of income. Now, tightening sanctions may not be incredibly effective simply because if you stop flows through one region, trade may become intermediated through other countries, even countries that do not necessarily share a land border with Russia.
And to what extent do you think that those high levels of growth in Central Asia are sustainable moving forward?
Well, it's difficult to judge. It is going to depend on what will happen with intermediated trade. It will depend on whether the relocation of labor and capital from Russia was a one-time phenomenon or whether more people and more companies are going to relocate. And finally, it also depends on the strength of the Russian labor market, which is responsible for the remittances flow, which for some of the smaller countries, such as, for instance, the Kyrgyz Republic, account for a very large share of the GDP.
And I guess a conversation about the regions that the EBRD covers wouldn't be complete without talking about Turkey, which has sort of been an outlier given high rates of inflation in excess of 50%, I think. What are your sort of predictions moving forward? It looks like President Erdogan may be returned. We don't know yet. But if he is, what does that mean?
Over the last several years, Turkey has prioritized economic growth over macroeconomic stability. But there is a limit to how long one can defy the laws of economics. So whoever is in the government will have to face some hard choices very soon.
And I imagine those hard choices may entail raising interest rates.
Well, these hard choices will also pertain, for instance, to the contingent liabilities that have been accumulated through deposits that are linked to foreign exchange. In the case of lira depreciation, that would mean that the authorities would be on the hook to cover large sums. So interest rate is only one of the factors that matters. And of course, we must not forget that Turkey was hit by a large earthquake. As a result of that, we are projecting that the GDP of the country will go down by about 1% this year. This is the adjustment due only to the earthquake. Obviously, as a whole, Turkey is expected to grow.
And just sort of finally, there's been a lot of banking instability, specifically in the US. I wonder to what extent you feel that may have, how concerned are you about banks in the regions that you cover? Are they strong? Are they stable?
So the region differs in two respects. Because households are poorer, a larger share of deposits is covered by deposit insurance. And also because the financial markets are less sophisticated, there is less alternatives. There are fewer alternatives when it comes to where people can invest their money. Now, of course, that does not make the region proof when it comes to a banking crisis, and there is no crisis until it happens. Now, what worries me more is the discussions about lifting the debt ceiling in the US. In 2011, we saw the US debt being downgraded by Standard & Poor's. Should such a downgrade happen this year, it is going to send jitters through capital markets, and it's likely to increase the cost of borrowing for many emerging countries. If you look at Egypt, for instance, the cost of servicing public debt is already projected to amount to 60% of tax revenues. If interest rates were to increase, it would be much more difficult for governments in emerging countries to service public debt and to roll over the debt that comes due this year.
Well, let's hope we have a speedy resolution to that situation in the US. Beata, thank you so much for joining us.
A pleasure. Thank you, Anita.